Inflation has begun to rise again for the first time since March. If you take a look at this CPI chart here, you can see that the inflation rate rose from 2.4% in September up to 2.6% in October. The last time the inflation rate rose was going from February at 3.2% to March at 3.5%. So is this just a coincidence? Considering that the Federal Reserve started cutting rates in September for the first time in 4 years, it's possible we are looking at the beginning of a new round of longer lasting inflation. If you don't know who I am, my name is Joe Brown, and I'm a former stockbroker who spent years advising the top 1% on how to manage their wealth. After I made enough money to leave that corporate world behind, I've turned my attention to teaching regular people financial techniques that exist outside the mainstream, things you'd never hear from your financial advisor or a stockbroker. And one of those things is looking at the importance of the money supply in determining the direction of both the economy and prices. You can see the growth of the money supply had a very similar trend line from 1995 all the way through 2020. When all of the money printing started, the money supply took a massive jump and peaked in April of 2022. That's when the Federal Reserve tried to put the inflation genie back in the bottle and started doing some things to shrink the money supply, which it did until it bottomed out about a year later in August of 2023. But if we zoom in here on the last year, we can see that the money supply has actually begun growing again for quite some time now. Going back to this chart, which is the federal funds rate, the interest rate that the Federal Reserve actually controls, we can see they didn't start lowering rates again until September of this year. Zooming in here, we can see that interest rates were at a multi-decade high for many months leading up until September. Now, this would lead many to believe that falling interest rates have more of an effect on inflation than the money supply. After all, the Federal Reserve starts lowering interest rates for the first time in 4 years, and within 2 months, we have rising inflation again, which we haven't had for over a year. Meanwhile, the total money supply has been growing for a little over a year, and it hasn't caused any resurgence in inflation until now. So again, on the surface, it would seem as if the money supply has less of an impact on prices than the Federal Reserve cutting interest rates. But hang on, how does that make any sense when we look at other interest rates, like let's say the yield on the 10-year government treasury? We can see that pretty much since the moment the Federal Reserve cut rates, the 10-year treasury yield has gone nowhere but higher. Similarly, if we look at mortgage rates, we can see that about from the moment the Federal Reserve cut rates, mortgage rates have done nothing but move up. Now, you and I cannot access the federal funds rate. That is the amount that banks get paid to hold reserves overnight with the Federal Reserve. And so if the other forms of debt that you and I and institutions can access is getting more expensive, how does that suddenly lead to inflation moving up again? Well, there's two things going on here. The first thing we have to look at is the lag that takes place between when the money gets printed and when it actually hits the prices of goods and services. For the most glaring and obvious example, let's take a look at the money printing that happened in 2020. One of the largest increases in the dollar supply in history, and it began February, March of 2020. However, when we take a look at the prices of goods and services as measured by the CPI, it was not March and February of 2020 that prices started to increase. In fact, they went down and did not recover to their previous high until a full year later in March of 2021. After that is when prices of goods and services started to skyrocket until they peaked a little over a year after that in June of 2022. And again, I'm talking about the inflation rate here, not the absolute price level. Prices continue to move higher. The inflation rate is the speed at which prices are moving higher. So just because inflation goes down does not mean prices are going down. They're always going to get you, and those prices are always going to still keep on going higher. Now, in contrast to the prices of goods and services, let's take a look at asset prices. This is a chart of the S&P 500. We can see that they bottomed in March of 2020 when the big money printing really started getting going, and almost immediately started moving higher, and we're already back up to their previous all-time highs just a few months later in August, which means that asset prices move first. The S&P 500 was up 81% from its low. We can see that the S&P 500 was already up 81% off of its lows by the time that the CPI got back up to where it was before 2020. This is a demonstration of the Cantillon effect. When new money comes into existence, the first place it goes is asset prices. Those asset prices get bid up as the people who get the money first place that money into assets in order to protect themselves and make money, which is usually the politically connected and the rich. All that buying pressure drives asset prices higher, and eventually, as the money gets spent through the economy, it goes from person to person, from company to bank account to bank account, and along the way, it bids up the prices of the goods and services that the people are buying along the way. And like an auction does, when more demand and more buying power comes in, it pushes the price level higher. This is why asset prices move first, because you can load a bunch of money into assets extremely quickly, capital scales very easily, versus goods and services. It takes time for that money to work its way through the economy. And so the money supply has now been growing again. Even though it's only a little bit, it has been growing again for about a year now, which is roughly the amount of time you would expect before you start to see its impact on the prices of goods and services. Meanwhile, if you take a look at asset prices over the last 1 year, we can see that they are already up about 35%. Okay, but this lag between money printing hitting prices of goods and services as it hits asset prices first only explains part of what is going on. The second thing that's going on is who has access to the cheaper debt. Federal Reserve has lowered rates for the first time in 4 years, but that is not translating to lower interest rates for other forms of debt. The 10-year treasury is a very good proxy for things like mortgages and auto loans and other interest rates. And as the 10-year yield has gone higher and higher, that means borrowing for some people has gotten more expensive, but the Federal Reserve is lowering rates for others. The main beneficiary of the Fed lowering interest rates is the US government itself. This is a chart of the US government 6-month yield, which has significantly moved down. When the government borrows for a very short amount of time and has to repay that debt in under a year, that debt follows very closely to the federal funds rate. This gives the US government an incentive right now to borrow as much debt as they can at the short end of the curve because they know the Fed is lowering rates. So if they borrow for 6 months and have to repay it, odds are they'll be able to borrow new debt at that time to repay it with debt that is cheaper, lower interest rate debt, as the Fed is continuing to lower interest rates. And expectations are that the Federal Reserve will continue to cut rates even into January, with the odds of interest rate cuts at over 25%. If you're not aware already, all dollars are lent into existence. That is how the fiat banking system works. If a dollar exists, it is because a loan created it. When you take your dollar that you got from a paycheck or a sale, you deposit that into a bank account, the bank is going to take that dollar, they're going to lend it out to somebody else. You now have a dollar, and so does somebody else that got put into their bank account from that loan. And so on and so forth, the system goes. That is how it works. So we know all dollars are loaned into existence, which means the more debt there is, the more dollars there are. So if we are seeing the total money supply grow, we would expect to see the total debt supply grow. And over the last year, we have seen all commercial bank credit continue to grow, along with the US government's debt, which is at about 36 trillion right now, continuing to grow, which means that these lower interest rates are directly contributing to the financial institutions and the government being able to borrow at cheaper and cheaper rates. In other words, loan dollars into existence. The more money that comes into existence, the more money you have chasing the same amount of goods and services, aka the more inflation in goods and services you can have. Now, you might think it's odd still that long-term rates, especially for people like you and I, like for mortgage rates or auto loans, are still increasing. This is to be expected if you know anything about the long-term debt cycle. If you take a look at interest rates going back 100 years, you can see there was about a 40-year cycle from 1940 through 1980 where interest rates increased. This was a time when the Federal Reserve was doing things like yield curve control in order to help the government deleverage from all of its spending from World War II. This was a time period of inflationary deleveraging for the government, which meant they basically printed money in order to cover their liabilities. They deleveraged themselves, got their debt to GDP level back down to normal, manageable numbers. Meanwhile, the economy soaked up all of that economic pain. People had to pay higher and higher interest rates for debt and higher prices for their goods and their services. But that cycle ended in 1980 and we embarked on the exact opposite trend, with interest rates falling for the next 40 years, with the government being able to lever itself up, borrowing more and more and more at cheaper and cheaper and cheaper rates, until that cycle ended in 2020. You can't go below zero with interest rates, and the debt to GDP ratio hit about 120%, which means that the future will look not similar to the last phase of the cycle we were in, with interest rates falling and debt to GDP increasing, but the cycle before that, with interest rates rising, inflation rising, and the government's debt to GDP falling as we go through an inflationary deleveraging. If none of that makes any sense, just expect higher prices and more expensive debt for the foreseeable future. This is not a short-term thing, this is a long-term thing. And most notably, we're gonna see higher and higher prices in the things that people have to continue buying no matter what, which is why even though the official total inflation number is fairly low right now, we see much higher inflation numbers in things that people still need to buy, like eggs at 30%, condiments at 22%, juices and drinks at 14%, beef at 6%, butter at 5%, electricity at 4.5%, car insurance at 14%, health insurance at almost 7%. Again, the things that people have to continue to buy and will continue buying are things that are going to get hit hardest for the foreseeable future. This means you definitely want to maintain ownership of and exposure to hard, scarce assets. This means that you definitely want to maintain portfolio exposure to hard assets, scarce assets, and assets that produce income that will rise with inflation. And if you'd like me to help you apply ideas like this to your investing so that you can grow your wealth and protect it during times of crisis, click on the link in the description below. As always, thanks so much for watching. Have a great day.